is going on right now. If you don't want to be recorded, then you'll have to jump off. But we will have this thing going on a record the whole time. First, I want to thank everybody for coming and joining us. This is the first time we've done it. As if you've been on for the last 10 minutes, you heard us all scrambling trying to get our video feeds working and our audio feeds working. I've got Andrew Goldberg with his video, and I've got Willie Barnett, who's having some technical difficulties on the video, but we'll have him on audio in a few minutes. Fortunately, we're going to start the meeting, and if you're looking at my family there, that's the desktop of my computer. So I've got Andrew's comments. Andrew is a senior analyst with J.P. Morgan. We're very privileged to have him on board with us. I don't have his full bio to read for you, but let's just say he's a fun guy to talk to and listen to, and I'm going to let him take over. We've got his presentation. I'm driving his presentation, so we'll put it over here like this, and Andrew, as you need a slide, you just let me know, and I'll go to the next slide you want.
Okay. Can you hear me okay before I get going?
I can hear you, and everybody else is muted.
Okay, fantastic. So I just want to start off, and what I'm going to do is very briefly walk through some basic observations that we're making about the economy, some of the challenges, as well as some of the things that are actually going right. Because believe it or not, there are a couple things that are going right. And then I'll kind of hone in on what some of the political challenges look like and turn it back to you if that's okay. I titled this presentation Slow Healing. Granted, the presentation changes pretty regularly with the data. But I would characterize this as an economy that is slowly healing. If you go to the first chart in the deck, Ralph, so you'll have to skip past this landing page and go to the first chart that you see. It's slide number 3 there. It's just a picture of the U.S. economy and GDP growth. Am I the one that's supposed to click that? Or?
I got it. Is that what you want?
Okay. I'm not seeing it yet, but
it's okay. It should be. It should be there.
Okay.
Do you see it?
I don't see it quite yet. I'll speak to it, and hopefully, oh, there you go. Now I see it. Essentially, what you've got on the left-hand side of this page is a picture of U.S. economic growth, and the fact is, you don't need a strategist from J.P. Morgan to jump on the phone to tell you that GDP growth has been really, really slow. I just think that the important thing here for investors to keep in mind is that there are 2 different ways you can think about the economy right now. The first is, man, this economy stinks. It's only growing at 2% or even less, and that's really disappointing. And it is, but there's another way to think about it too. And the way that I like to think about the economy, and I think it's the right way, is that in the face of all these extremely intense headwinds, you've got this major problem in Europe, political uncertainty here in the U.S., and the threat of the so-called fiscal cliff. You've got uncertainty with geopolitics in the Middle East. And last year, of course, we were dealing with the downgrade of U.S. long-term debt, the huge earthquake and tsunami in Japan, the Arab Spring and oil prices surging. And in the face of all that, what you can see on this chart is that GDP has actually grown for 12 consecutive quarters, which in my view is a pretty astonishing achievement and in fact demonstrates just how resilient this U.S. economy is. So there are 2 ways to look at this. You can say, oh, woe is me, you know, the economy just stinks. Or on the other hand, don't you think it's pretty amazing that the economy continues to grow despite all this stuff? And in fact, you don't need to take my word for it. Go to the newsstand and pick up this week's edition of The Economist magazine, which on the cover showed a picture or some kind of abstract depiction, I'll leave it at that, of Uncle Sam flexing. And the title was Comeback Kid. And the article was just all about how rapidly the U.S. economy has moved to adjust to some of the imbalances that caused the recession. So my view is, think of the economy not just as this weakling, underperforming, underachieving economy, but rather an extraordinarily resilient one in the face of some intense headwinds. And also think about what's possible as those headwinds are removed. If you go to the next slide, and I'm going to go through these next few rather quickly, on the right-hand side you can see in large part why it's growing slowly. 70% of the U.S. economy, and that's not shown here, but 70% of the U.S. economy actually comes from consumption. But over there on the top right-hand side, you can see that we've actually been saving more. And on the bottom right,
yeah, just ordered just with.
Someone was chiming in there. On the bottom right, you can see, no problem. On the bottom right, this is just one measure of how people are spending, but it's a measure of debt. You can actually see that people have been reducing their debt. So after a severe recession and after the housing bubble blew up, it's going to be a very natural thing for people to save a little bit more and spend a little bit less. And that's going to cause for a slow recovery. But over time, if you think about what this will mean for the consumer, they'll be lean, mean, ready to spend. It's just going to take some more time. I think we're in an 8 to 10 year process. We're 4 or 5 years through it. So it's an economy that's reinventing itself. It's healing, but very slowly. Ralph, just in the sake of time, what I might do is actually skip the next two charts and go to what is labeled as page 8, which looks at housing. And so I'm just going to show you 3 quick things in terms of what I think is helping here. The first one, as you can see on the left-hand side of this page, is a picture of 3 different indices that represent the housing market and home prices more specifically in the U.S. And after going all the way up and then all the way back down and then sideways for a long time, home prices have finally started to tick higher. Now, it's too early to say that this is it. It's too early to say that they've bottomed, and there are other structural complications that we don't need to address on the phone today, but suffice it to say, home prices and housing in general has gone from something that's been a headwind to something that's actually more of a tailwind. Going forward, this is more likely to give us a boost. Don't underestimate what this could be of higher home prices over time. And so I think that's just something that's really important. If you go to the next slide, there's something else that's helping. The other thing that's helping tremendously is that, and you can see this on the left-hand side, oil prices, that's the orange line, and gas prices, which are the gray line, have come down significantly so far this year. And while they've come down significantly, just think about it in dollar terms, in human being terms, if you will. For every 1 penny that gas prices go down per gallon, that's, think about all the gallons you use in a year, and then multiply all those gallons times that 1 penny, and then multiply that times the 240 million people that are driving cars in this country, and you start to get a sense of the massive scope of the savings that this represents in the pockets of U.S. consumers. The top right-hand chart on the page actually shows a picture of what we call the economic drag of oil prices. And what you can see is that the higher oil prices go, the more money gets sucked out of our economy and gets sent to those that we're importing it from. And when oil prices are down, it reverses that, and we've seen the beginning of a significant reversal. The last quick thing I'll point out, and this is also pointed out in that Economist magazine article that I mentioned, the U.S. today is importing less oil than at any other point since 1995. There's a mini energy renaissance going on in the United States, and that's all contributing to what I think could be the foundation for a stronger recovery in time. And then there's one last thing that I want to talk about in terms of what's helping. It's the very next slide, slide 10 in this deck. And that is we're in earnings season right now. Now, the rate of corporate profit growth, and that's the chart you see over on your right-hand side, but the rate of corporate profit growth has slowed significantly. That's normal at this stage in an earnings cycle. Companies, when there's a recession, quickly move to slash costs. They lay people off, they cut back on technology spend and R&D and CapEx, and that helps them return to profitability very, very quickly. But you can only cut costs so much. And so into a recovery, the rate at which you can actually boost earnings growth actually begins to slow, and that's absolutely perfectly normal. And what you see on the right-hand side is the mix of earnings growth. The gray part at the top looks at how much comes from margin expansion, or in other words, cost cutting, and then the green part at the bottom looks at revenue growth. And for going forward, earnings are going to be driven by revenue growth. So that's what's helping. Now, just for my last section here, if you skip ahead to slide 12, there are a couple things that are hurting. And I think first and foremost, it's uncertainty related to politics. And I know that Willie, who's an expert in taxation, is going to talk about some of that more specifically. But what you see on the top left-hand side of page 23 is basically a quantification, there it is, of the extent to which our two political parties can't agree. They are as polarized as ever before. And so essentially these orange and this gray line measure the percentage of votes cast in the House and the Senate that are cast strictly along party lines. So when you see them up there around 90 to 95%, it means that only 5% of any vote on any bill are willing to cross over the aisle. That's as bad as we've ever seen, and the result on the top right of the chart has actually been that approval ratings for Congress have hit a new all-time low, under 10%. That's astonishing. Now, that said, and I would really urge you to consider this, and remember this, as much of a headwind as this has been, and there's no doubt that it's undermining confidence, that politics are holding back the economy from growing even better. But do not bet against the power of the U.S. private sector economy on account of some political headwinds. This has been going on for a couple of years now, and while you don't need to go back to it, if you actually look at the previous chart, you'll see that 2 quarters ago, corporate profits hit an all-time record high, all-time. And this is in the face of some and there you see it right there. That massive V-shaped recovery in corporate profits has been happening amidst the most divided Congress in U.S. history. Every single day, the CEOs of companies all around the world, and especially in the U.S., like the CEO of, I'm just making it up, but McDonald's, wake up and trying to figure out how to sell more cheeseburgers all around the world. And so the election's going to come, and the CEO's preferred candidate loses. You think they give up? No. They're still going to try and figure out how to sell more cheeseburgers all around the world, and they're pretty good at it. And corporations are very well capitalized. So this political thing absolutely represents a headwind, and that's something that concerns me. But don't bet against the private sector economy on account of it. The next slide, and I'll leave this for Willie to address, briefly looks at the tax situation. And on the bottom left, all I will say is that the gray bars are where taxes are today. The orange bars are where they could go if Congress doesn't reach a compromise on the so-called fiscal cliff, and it would ultimately amount to the greatest tax increase in U.S. history. It's something that, just from a market strategist perspective, is holding confidence back. I'll leave it there. I'll just mention 2 other things, Willie. Ralph, I don't think we need to go into the charts, but I will also say that uncertainty from Europe is going to be around for a while, and that's going to result in volatility. I also think that people are closely watching China and slowing economic growth there. But the final thing that I'll just say about all of it and taking it all together is this. We know that there are some major risks out there. There's volatility. There's Europe. There's geopolitical risk. There's the fiscal cliff and uncertainty with politics in the U.S. And when you think about that fiscal cliff, we worry about taxes and interest rates and inflation. But what I would also remind investors is simply this. The solution to the things that plague our portfolios actually comes from investing. And I say that with hand on heart. Just like the iPhone says there's an app for that, for every investment concern, there's a strategy for it. And I can guarantee you personally that, and this is through working with Ralph for a long time, but if you're concerned about taxes, Ralph has a couple ideas for you. If you're concerned about interest rates, Ralph has a couple ideas for how to protect your portfolio. If you're concerned about the fiscal cliff causing slower growth in the U.S., we know how to get growth into a portfolio, and the results speak for themselves. If you look at historical data for a basic diversified portfolio over the last 10 years, they've just far exceeded the S&P 500 alone or cash. And this was a decade, by the way, with multiple wars, multiple recessions, 2 of the worst bear markets in U.S. history, 9/11, Hurricane Katrina, global financial crisis, European credit crunch. And actually, Ralph, if you scroll down, there actually is a picture of this basic portfolio I think it's one of almost the very last chart in the deck right there, number 22. So ladies and gentlemen, just briefly, on the far right-hand side in the second to the last column, that 82.8% return is for a portfolio that's, get this, 55% stocks, 30% bonds, and then 15% spread across non-correlated assets like real estate or commodities. So over that decade, with all those nasty things, a very, very basic portfolio, just an average investor's portfolio returned 82%, where, as you can see all the way at the bottom, cash returned 20. The U.S. stock market only did 33. But your portfolio is much more diverse than that, much broader than that, and that's why I say the answer to our concerns when it comes to investing has to come from investments that are driven to focus on those things. So I'll leave it at that, and Ralph, we can go back to you, and hopefully I can answer any questions that you've got towards the end.
Okay, great. Thank you, Andrew.
Sure.
I've got Willie. It looks like Willie's back online here. And Willie, are you there?
I'm online without video. The guy recommended I uninstall the app.
Okay,
good
well,
time to uninstall the app. So
I'm going to
sorry, everybody.
I'm going to pull your slides up, take Andrew's down, and pull yours up here. And Willie Barnett's been with Putnam for about a decade, a little over a decade now. And he and I have also worked very closely. And Willie, if you just want to direct me, you can see the slides, correct?
Yeah, I can. Thank you. The deck I'm going to go through kind of is split in half. The first half kind of just backs into what we're facing here this fall, as Andrew alluded to. So I think I'll go rapidly kind of through the first few slides so we can get to Q&A and try to get to the meat of it as quickly as possible, Ralph, if that's okay with you.
Fine.
So,
Fine.
So you can see that we're halfway through the year here, and this is what we faced last year, obviously. Ralph, if you just want to kind of go through the first few slides, we can just, I don't want to depress everybody, but if you want to start on 4, actually, that probably
start
works.
on 4, okay. There you go. Okay.
So, we're facing huge budget deficits that everybody knows. This stuff on nightly news every night, that after 2008 to try to get the economy back and growing, our government has decided to spend and spend and spend in 09, 10, and 11 to the point where we're at about a $50 billion deficit each month, $1.3 trillion for 2011. So the question is how we're going to pay for this stuff, right? And to go to the next slide. This is all the depressing stuff, I promise, so I'll try to go as quickly as possible. You can see that if you look at our debt as a percentage of our gross domestic product back in 1940, that we're creeping up to what we were just after World War II. And a lot of economists out there say that 120 is the magic number, that when your debt as a percentage of your GDP hits 120%, what a lot of the European countries are running up against, that your ability to try to pay that down, it just is compromised. So 96, 93% currently and rising. Go to the next slide. The next few slides just kind of break down, okay, well it's bad, Willie, but what's it comprised of? How can we fix it? And a big problem is the entitlement program. I don't think I'm breaking any news to anybody, but between Social Security, you can go to the next slide, Social Security, Medicare, Medicaid, the percentage of spending that is non-voluntary, if you will, and mandatory is over 6%. That when the government sits down with pencil to paper, 63% of the game currently is over, unless they want to try to. You can go to the next slide. Try to revise Social Security, Medicare, Medicaid, which a lot of our elected officials obviously are unwilling to do. So you pair that with where we are from a tax rate standpoint, and after the Bush tax cut, Bush 2 tax cut, you can see tax rates in the United States are as low as they've been for a very, very long time. You go to the next slide, Ralph. You can see, obviously, that even from an estate tax point, so from an income tax standpoint, from an estate tax standpoint, our tax levels are as low as they've been for a long time. And this just shows the exemption amount for estates, and then also the top tax rate, excuse me. So we're lowest on the top tax rate for estate tax, and we brought up the exemption amount to historic highs. So something's got to change. If you go to slide 12, Andrew had this slide in another form and showed the red arrows pointing up to the 43.4%. We presented it a little different way, but everybody talks about the fiscal cliff, and this is a large part of it right here, that without anything being done between now and December 31st, ordinary income taxes at the top bracket are going from 35 to 43.4. Estate tax at the bottom there, you can see, drops from a $5 million exemption, 5.12 to be exact, back down to 1. Payroll taxes are going to jump. Capital gains rates are going to jump. Big one there, the second one from the top, dividends. A lot of people have been jumping on utility stocks and dividend-paying mutual funds. If you're in an after-tax account, you definitely want to be talking to Ralph, because the dividend taxes, if nothing is done again, and we don't think anything will be done this year, that obviously nothing will be done before the elections, and then that leaves such a short amount of time for anything significant to try to be done after the elections that we don't see anything being done this year. So you want to go down to the next slide, Ralph. This slide is the one to remember, folks. So you can go to the next slide, Ralph. Yeah, so this slide talks about the healthcare mandate, and is a surprise to many of us, I think. The Supreme Court, a lot of people call it Obamacare, across the board said that it was constitutional from the standpoint that government can tax us. So across the board, Obamacare will go in, and that adds another over 3% in taxes. So what are some of the things you can do? If you go, Ralph, to, I think it's 16 maybe. I'll try to focus on the positive, and the gist of all this, folks, is between December 26th isn't the time where you want to call Ralph and say, hey, what can we do about the oncoming tax increases that are going to happen. We think right now, and in the summer when things are nice and quiet, is the time to pick up the phone and be talking to Ralph. So thank you. You've taken a good first step by being on this WebEx, so thank you for that. But definitely look at some of these things that I'm about to go through, and whether it's accelerating income, if you have that ability, accelerating income in 2012, when rates are going to be lower, that's one thing you can do. Considering Roth IRA conversions, I know I've done quite a few seminars on that topic over the last few years, and with the volatility of the market, it's been tough, and it's a tough pill to swallow to pay the taxes that you would need to do the conversion. But having that tax-free stream of income the rest of your life is something that you really need to be talking to Ralph about, because we're at Putnam Investments big on having tax diversification. You talk about diversification in your portfolios and bonds and stocks, international, and all that good stuff. But we think diversifying from a tax standpoint makes a lot of sense too. Put your money into different buckets that you can draw from throughout your lifetime. You can go to the next slide, Ralph.
It's going. Come on, there we go. You got it.
Okay, so that okay, there we go. So you're going to see a theme here, right? So accelerate income if possible, accelerate deductions if possible, pay mortgage interest, make charitable contributions. Now, right now, you know what the rules are. Our sense is something will be done, most likely for earners, if married, filing jointly north $250,000. Something will be done in 2013. And it'll be retroactive back to January 1st. So they don't have to get this stuff to make changes before the end of the year. April, May, June of next year, they can make changes and just make it retroactive back to January 1st. So while you know the rules and while you think, if you're in that bucket of people north of 50 if you're married, 200 if you're single, 200,000 if you're single for income, you're one of the people being targeted. So you can go to the next slide. These are the things to think of right now and have the discussion with Ralph. You can go to 18, Ralph.
I'm at 18.
So perfect, thank you. So accelerate income, accelerate deductions, look at your estate planning strategies. It's time to break out the trust if you haven't in a while, and look at what the exact words are, share it with Ralph, share it with your state tax planning attorney, make sure everybody's on the same page. Lifetime gifts is also another opportunity that's out there. You want to be talking to Ralph again about that, or your state tax attorney. I'm big on having everybody on the team know. I'm encouraging my financial advisors that I talk with to call out to their top clients and go to lunch with the financial advisor, the CPA, the estate tax attorney, and the client and the spouse. And those 5 people sit down at the table and make sure that everybody's on the same page. And that, like I said, summertime is a good time to do that before the holidays, before this stuff gets down to the nitty-gritty deadline. Go ahead, Ralph.
Okay, number 19's up.
Yeah. Sorry, I'm having a little delay. So it's the whole thing. The whole thing is just to hedge against the uncertainty. You don't know what's coming. You don't know if you're going to be one of the people affected or not, but you know what the rules are now. So sit down with Ralph, like I said, have that lunch with your team of advisors, make sure everybody's on the same page. And there's some very smart and bright people out there that know exactly what's best and what's in your best interest. So make sure that everybody's on the same page and moving in the same direction with all these coming at us.
Thank you, Willie.
And Ralph, my pleasure.
I'm going to unmute the lines so that you can jump on with a question if you have it. There might be a more elegant way to do it, but for now, everybody's unmuted. So if you want to say something, or if you have a question for either of us or any of us, go ahead and ask it. And if you don't, you can mute your own phones.
If you want, Ralph, you can put it on slide 20. There's some closing thoughts there.
Okay. So, Andrew, one of the clients asked me, who couldn't participate today, asked a legitimate question, and maybe Willie wants to answer or Andrew, but what do you anticipate the trading climate to be between now and the elections? I've been telling people one thing, but I'm just curious as to what you two guys feel we can anticipate going forward until November 6th.
Sure. Well, I'll start there. In terms of the trading climate with the market, I think there's a couple things that I would anticipate. The first is you've probably noticed that volume, the amount of shares trading in either the New York Stock Exchange or any other market for that matter, has been extremely low. And I think the reason is, Ralph, that if let's say you're bearish and you think that there's going to be a bad outcome in Europe, or you think there's going to be a bad outcome with the fiscal cliff and the election, but the market's been trending over time higher and higher, you probably don't have enough conviction as a bear to go out and short the market really hard because you're afraid you'll lose your shirt. And conversely, if you're more optimistic, or if you would consider yourself bullish, you might be bullish, but why not wait a little bit before you really bet hard, because there's enough that could go wrong. And so I think there's just this lack of conviction, either by the bulls or by the bears, which is resulting in low volatility. Low volume. Now, that can actually give rise to an awful lot of near-term volatility, because when something does come up, there's not enough massive volume in the market for a big trader to prevent all that volatility. So I think it's going to be a bumpy road. But on the other hand, I think that like last year and the year before, we're going through a soft patch in the data, And my best guess would be that the rest of the year things start to improve as the economy moves through this soft patch, which is not something that's unfamiliar to us. That's my best guess. By the way, just to throw a couple numbers at you, which is kind of interesting, but I pulled this up a little bit earlier. Would you believe that in the last 12 months, while the Greek stock market's down 66% and emerging markets are down 15%, and Europe broadly is down 17%, the S&P 500 for the U.S. stock market is up, and it's up 6%. So it's outperforming the rest of the market by over 20%. So when the Economist puts a picture of America on the cover and says, "Come back, kid," it's not a joke. And year to date, the U.S. stock market's up 10.5. So while I say it'll be bumpy and a lot of uncertainty, I also think it's important to remember that the U.S. markets provided quite a bit of shelter from the storm outside.
Willie, did you want to make some comments?
Yeah, it's a very interesting time and an interesting summer for us. Summer's usually, everybody says sell in May and go away, and the last that work for you. And remember, the last 3 years we've seen a 20% correction peak to trough the market each year. So Andrew's right with the volatility. We got to keep an eye out towards that. And when volume is this light, he's exactly correct that volatility can sneak up at any time. What we're seeing, interestingly, is the institutional clients, the sovereign wealth funds, the countries, the big pension funds, aren't taking the summer off. In fact, they're some of the busiest that they've been in years getting positions ahead of the election. At Putnam, not to get political, but we try to call it as we see it. We think Obama wins in a close election. That right now, if you look at the swing states, they call them, these are the states that are going to matter, the ones that are going to really determine the election. That Obama's lead is at least 15 points and growing. So 10 points and growing, up towards 15. So we see Obama winning a re-election in a close race, but with that, then this conversation really is apropos because the taxes on the upper income earners are really going to hit. So we see a lot of institutions taking positions ahead of this, and where they were taking positions earlier in high yield assets, high yield fixed income, floating rate, bank loans, those types of things. Now they're starting to shift over towards emerging market, and as Andrew so aptly said, the good old USA. If you look at the earnings that are coming through day in and day out right now during earnings seasons, almost every company is beating expectations. Not by a lot. There's not a lot of blowouts out there, but the majority are beating expectations. And if you look at some of the big names out there, if you look at their balance sheets, they have pristine balance sheets, a lot of cash on the sidelines, waiting for that clarity, waiting for that visibility from the climate, from the government, from everything that we're talking about to figure out how best to deploy those assets. And right now, some of those are raising share buyback. Some of those are increasing their dividends. And I'll tell you, with a 1.5% yield on the U.S. 10-year, there's a lot of companies out there, Verizon with a 6% dividend, AT&T, and on and on and on, where you can lock in a pretty good yield, and that stock price doesn't have to move very much for you to get a healthy return. So something to be talking to Ralph about, that where to position assets ahead of the election.
One thing I would add to that, Ralph, is just also that, to Willie's point about dividends, some good news, and I'm not a political expert, so I don't want to predict what'll happen and what the timing will be. But earlier this week, actually I believe it was last week, the Senate Democratic leaders actually came out and clarified their proposal for tax rates, and they actually said that they would cap tax rates on capital gains and dividends at only 20%. So they would go from 15 to 20, which, if that were to be the case, and by the way, of course, they're doing this because they're fearful of losing voters, then the tax consequences that people are concerned about would be far less significant than feared. So it's impossible to predict these things. But people need to be balanced in just because of that ever-increasing likelihood that compromise gets achieved at some stage and that worst-case scenarios don't play out. The market, as a forward-looking mechanism, may have already priced for a potentially bad outcome. But when you see proposals like that from the Senate Democrats saying, you know what, we're going to back off of these higher tax rates for wealthier families or higher income families, the markets are going to respond to that. And so I think what I would wrap up with is just that, did you know in the last 3 years, investors in this country put more money into bond funds than they put into stock funds during the tech bubble? So the environment in the last few years has been even more lopsided than the tech bubble because people have been nervous enough to just put all their money in bonds or keep it in cash. Now, during that 3-year period where all the money was going into bonds, the stock market went up 111%. And so I'm not saying put all your money in stocks or anything like that. I'm not saying everything's going to be fine. But I think it's important that investors stay balanced, and instead of just saying, I'm not going to play this game, they do exactly what Willie's saying, and hey, so what are my exposures when it comes to taxes? You know, how does this trust look? And get in your office and have that meeting with you. I got into this industry 10 years ago because my father's a financial advisor, so it's kind of near and dear to me. But I think it's about being balanced and being thoughtful about what these risks are, because you can address them in the portfolio. That's what it's for.
Good deal.
Any of the participants have any questions that are out there?
Hey, Ralph, Dave Regan.
Go ahead, Dave.
Willie and Andrew, great presentation. Couldn't agree with you more. I had to at one point jump off the call, so forgive me if I'm going to make you repeat yourself. But did you have any thoughts on just the unemployment rate in the country? You see it rising, or just what are some of the thoughts on that? I mean, I know anything outside of 6 months is pure speculation, but just wanted to see if you have any thoughts on that.
Sure. Ralph, is it possible to pull up somewhere in that deck that I provided? There are a couple pages that look at it. In fact, I believe page 5 looks at the unemployment rate, and we can start there, and then I'll talk about the page just following it. So the unemployment rate has come down from a peak of over 10% to where it is at 8.2%. Take that with a grain of salt, of course, because that's not just because everybody's getting jobs, obviously. A lot of it has to do with the fact that the way the unemployment rate itself is calculated, what you're seeing is, at least some part of this, is people are saying, you know what, it's so hard to find a job, I give up. And if you don't actually look for work, then the government's not going to count you as part of the unemployment rate. So it's stalled out around 8%. Historically, that would, in theory, be too high for a president to get reelected, although I would net side with Willie and Putnam on that the president probably squeaked out a narrow victory, but it's too early to say. Now, the other thing that I would point out on this page on the right-hand side to kind of balance out this lackluster argument I'm making is that the economy has actually been creating some jobs. And the chart that you see on the right shows that for the last 26 consecutive months, the economy in the private sector has created jobs, and that's right, for a total of 4.3. Actually, if you look through today, it's 4.4 million. Now, to put it in perspective, we lost 9 million. So we've got a ways to go, and that goes back to this idea of slowly healing. But Ralph, if you go to the very next slide, you can actually take an even closer look at what's happening in the labor markets, and this is unbelievable, by the way. The chart on the left, if you look at the lowest line on the chart, the gray one, it shows that the unemployment rate for those with a college degree or better, so a PhD or an MBA, is only 3.9%. So in fact, if you have that college diploma, things for you are manageable. You'll find a job if you send out enough resumes and if you look hard enough. But 2 lines above that, the brown one, look at what happens if you only have a high school degree but no college. The unemployment rate for you is double. And if you don't even have a high school diploma, the unemployment rate for you is 13%. And none of these are including the people that have given up looking for a job. And then over on the right-hand side, we show that if you've got a high school diploma, for the rest of your life, your annualized compensation on average would be around $30,000. but it almost doubles to 56 or 57,000 with a college degree, and it goes up another 30,000 if you have an advanced degree. And so I think the message is this, and I'll try and weave this all together when it comes to labor markets. Are very mature and sounds like we're on hold somehow.
Sorry about this.
Oh, no problem. Okay, there we go. So I think the way to sum this all up is just that our economy is a very mature, very dynamic economy. But by mature, I mean that it's no longer going to grow just because of adding more and more, manufacturing type of jobs. The type of jobs that we create, and you can see it from this chart, are the type of jobs that are high paying, but they require a higher degree of education. And I think that over the next 5 years, what you're likely to see is as the country gets back towards focusing, and I hope it does, on education, you're likely to see that trend continue into the future. That's not to say that manufacturing is not important. In fact, the manufacturing sector in the last 18 years has grown by 50%, but it's just that the rest of the economy has grown up so much more than that the manufacturing as a part of the whole has gotten smaller. I think the future is gonna show that we'll create more higher education, higher paying jobs, and fewer of the low education. So education matters a lot when it comes to jobs. I hope that leaves you with something and makes some sense.
No, absolutely. Yeah, no, perfect. Thank you.
Okay. Oh, actually, and there's one other thing, by the way. One thing that we track very closely is the NFIB. It's the National Federation of Independent Business. They're basically the country's largest advocacy group for small business, which I think most politicians and economists would agree is the most important contingent in the U.S. economy for creating jobs. We track the NFIB Index of Small Business Optimism, and small business optimism is still very, very subdued. And if you look at what their biggest concerns are, it's extra regulation and taxes. Not competition from bigger businesses, not competition from overseas or anything like that, but they're concerned about the future and the uncertainty of what policy will be. And so that's something that's holding us back. Once the election comes, whatever the outcome is, at least there'll be more clarity, not less. And that actually, believe it or not, helps over time. It doesn't matter what the outcome is, it just matters that there is an outcome. And so I think what you're likely to see after the election is that small business optimism in the subsequent 6 to 12 months picks up and hiring picks up as well. It's a little prediction from me to you.
Great, thank you.
Sure.
That's good. That's good. Yeah, it's interesting that we brought the Obama. You both commented on Obama winning. That was one of my again, one of the clients that wasn't able to participate was asking. Assuming Obama wins, assuming health care goes through and doesn't get changed by the new Congress, and of course, even if they tried, the president probably wouldn't sign it. What's the impact of the health care bill going to be on small businesses?
It might be a better question for Willie, but what I can tell you just briefly about it is that one of the leading entities behind the lawsuit to repeal or to strike down the health care law was the NFIB. In fact, the day that the Supreme Court upheld the ruling, they actually had a banner on their website that said, "Supreme Court upholds health care bill, but we vow to fight it." So I think overall for small business, they're against it. It costs money to try and figure out how to implement it. It doesn't mean that businesses are going to give up. So don't bet against them. They're not going to give up, but it is a headwind, net-net. It's very good for the healthcare business, and you've seen that reflected in the sector stock prices. But my guess is net-net, the small business community doesn't want to see the re-election, and they don't want to see the healthcare bill come to fruition. Willie would probably be better to answer it than me, though.
I think that's right on. I would just add, watch out how this plays out. It's going to be very interesting. You might see quite a few small businesses opt out, decide to pay the penalty because that's cheaper for them, and now their people aren't covered. So it'll be very interesting to see how this plays out and how your economics comes to the market.
The law of unintended consequences, right?
Exactly right.
Participants, any questions? I have one more, well, actually a couple more, but that we solicited ahead of time. What are your thoughts on a late year rally, Santa Claus rally, that sort of thing? Do you think it's something we should count on, or what do you think is going to happen after the election?
Well, I would never say you can count on it, but if you look at what's happened, well, let's start with what's happened the last 2 years. Both years, 2010, 2011, were almost identical in that you had an early 9 to 10% rally to start the year that was building off strength from the prior year. But then from, call it April, May through July, August, plenty of weakness with, as Willie pointed out, essentially corrections, if not downright bear markets. And then these massive, if you want to call it a Santa Claus rally towards the end of the year, that everybody benefited from. Now, that said, if you look at the timing of those rallies, the beginnings of them coincided exactly with periods of additional Fed activity, the Federal Reserve saying we're going to step in and provide even additional accommodation and monetary easing, and we're going to step in and buy a bunch of bonds. And so the markets, always being addicted to additional sugar, rallied on that. Now, my fear with that is that what I call the shelf life of monetary policy is something I'm concerned about. The first such rally that we saw in 2010 actually saw a 30% rally after the announcement of QE. Then Operation Twist, which was in the following year, saw a 17% rally. I think there's not much more the Federal Reserve can do, if anything, to help the markets or the economy. They're for the most part out of bullets. Now, they can do a lot to preserve the stability of the banking system and make sure that credit doesn't freeze, but the Fed's not going to be able to get the economy to grow. I think the markets are getting tired of the Fed, and so the rally at the end of the year this year would not be because of the Fed. It would be because earnings actually come through despite all the headwinds. Europe makes some progress. Oil prices actually stay low, and housing continues to recover.
Well, and you also have the renewed certainty, or at least the clarification of the election itself.
That's a big one.
Yeah. Willie?
To me, that's more of a trader's dilemma. I agree with Andrew. I think the odds of something like that happening are high, but it's more of a trader's thing, and I think your clients are more invested in figuring out how they're going to get their money to last throughout their lifetime. A much bigger issue. So I wouldn't try to bite at that. The one thing I would say, Andrew alluded to this, the amount of money that's gone into fixed income since 2008 is so massive that when that day turns and interest rates start to rise, people figure out that they can lose money in fixed income, and they open their quarterly statements and see their bond funds losing money. That's going to have to find a home, and our sense is that that home will be large cap U.S. stocks. And when that flood of money pours back from fixed income into equities, that's going to be the next big leg up in this market.
Absolutely, I tend to agree with you on that. And we've been underweighting bonds for quite some time, and it's an important part of what we thought was important going forward. So, Dave, did you want to jump in with a question there, David?
Ralph, I had a question. My question is, can they give us in a nutshell, based on percentages, because obviously we're talking about the stock market with the politics and the uncertainty, but also including the tax ramifications from either president winning. So if Obama gets in, can you give us a percentage range of tax increase versus if Romney wins, what that percentage might be? Does that make sense?
Sure.
Yeah.
I mean, the best I can do there is, first of all, tell you that if the president wins, he's going to have a difficult time because it's likely that the Republicans retain the House, and it's actually plausible, whether he wins or loses, that that the Republicans gain some ground in the Senate as well. So even if the president wants to raise taxes on high-income households, he won't be able to do it to the full extent that his proposals would suggest because it's not going to go through Congress. On the other hand, if Romney wins, and I'm not making a political comment here, I'm just saying from a market perspective, my sense of things, and especially after watching the Scott Walker, name please? Mr. Walker's victory, not Scott, but the other one in Wisconsin.
Wisconsin.
Yeah. After that victory, when he survived that essentially confidence recall vote, the markets rallied. I think the idea being, if Romney pulls this off, my guess is that you're not going to see anybody want to lift a finger to raise any taxes on anybody, and for better or worse, the market's going to rally on that one, and so that's my best guess as far as what you're going to see. The one thing that I would also just point out here is that in 2005, and then they revised it, they made some tweaks to it in 2006, the Federal Reserve conducted a study to measure the impact of the Bush tax cuts on capital gains and dividends for the overall stock market, and they found an interesting thing. While overall equity markets didn't seem to exhibit any sort of impact as a whole, within the stock market, dividend-paying stocks versus high dividend-paying stocks and low dividend-paying stocks, there was some disparity between the performance there. And so I think the risk here is if tax rates on dividends were to go much higher than where they are today, like, back to ordinary income or something like that, you might actually expect to see the mix of stock performance change and high dividend paying stocks get hit. That's why I'm so encouraged by that Senate proposal from the Democrats that, hey, we don't want to lose any votes. Let's just keep them at 20%. So that would be a victory there. But other than that, I'm not so sure how much more I can guess about that outcome, unfortunately.
Okay, thank you.
Willie, any feedback on that as well?
That's a slippery slope. I'm just sitting here thinking all the different things that comprise the fiscal cliff, right? So the U.S. got downgraded last year, and they have $1.2 trillion that they need to cut due to the sequestration, the Bush tax cut sunsetting, and on and on and on, right? So all these things need to be dealt with individually and have to be voted on and have to be passed. And that's in essence what we're saying at Putnam, that Congress is so far apart, the Republicans and Democrats are so far apart that you're not going to get there. The compromise isn't going to happen, and these individual cliffs are going to happen one by one by one. So when you get into 2013 and they're forced to come to some compromise, that can happen. What shape that takes, I'm not going to get into percentages. I don't want to try to guess or mislead you. But I think that if you look at the slides that we presented, those numbers, the 43% number, are a big chance that those are reality come January 1st. So while you don't know what the real numbers are going to be, and if they make it retroactive at some point in 2013, like I was saying, back January 1st, deal with what you know the facts are now and play your hand.
Well, very good. Gentlemen, thank you. As one last chance for anybody who might have some questions. If anybody out there has a question, let me know. Speak up. I guess we don't.
And Ralph, if any questions come in after this fact, please send them on, and I'm happy to take a stab at them.
Appreciate that. I've got your email, and I've got Willie's as well. And if anybody you heard it straight from Andrew, I'm sure Willie's just as willing to answer any questions that you might have. Andrew said
Ralph has my cell phone number on his speed dial, so feel free to give us a call and get a hold of me anytime.
You don't want to go there.
Well, a little secret. Willie and I've played a few rounds of golf together, so he's down right here in Southern California, so it's real convenient. And he hits the long ball, so it's kind of fun to play as a teammate. But Andrew, I'll see you when I get back to New York later on this year, and
Fantastic.
hopefully. And appreciate your help. And with that being said, I'm going to assume that there are no more questions. I'll wait 3 seconds. No more questions. Thanks, guys. I appreciate it.
Thank you. Have a nice day.
Thank you very much.
This has been recorded, and I hope to have it up on our up on our website before too long. Take care now.
Thanks, Rob.
Bye-bye.
Bye now.
Take care.